If you're self-employed and you ever looked at your income and thought, I make good money, so why is it so difficult to qualify for a mortgage? There may be a specific reason for that. And it doesn't necessarily mean you can't qualify. The way your income is documented makes a huge difference. Let's start with the traditional mortgage side. When you're a W 2 employee, income can be fairly straightforward. You have wages, pay stubs, W 2s, and employment history that documents what you're earning. But when you're self employed, things can look very different. Businesses typically have business expenses and tax deductions. Those deductions can help reduce your taxable income, which can obviously be beneficial when you're doing your taxes. But there's another side to that. When you're applying for a mortgage, the lender isn't just necessarily looking at how much money came into your business. They're trying to determine how much qualifying income can actually be documented under the guidelines for that loan. So imagine your business brings in $150,000 over the year. That sounds great. But after legitimate business expenses and deductions, maybe the income reflected on your tax returns is significantly lower. That lower number may be closer to what a traditional mortgage qualification is based on. So you can have somebody who has a healthy business, plenty of cash flow, pays their bills, and still has trouble qualifying through a traditional income calculation. That's where people sometimes get confused. They're thinking about gross business revenue. The mortgage guidelines may be looking at qualifying income very differently. And I want to make something clear here. Being self employed does not automatically mean you need a non QM loan. Plenty of self employed borrowers qualify for conventional, FHA, VA, and other traditional mortgage programs. The point is, your income documentation may require a little more analysis than someone receiving a standard paycheck. That's why it's important to actually review the numbers rather than assuming what you can or cannot qualify for. Now, let's say the traditional calculations doesn't work well for your situation. Depending on the borrower and the loan program, there may be alternative options. One example is a bank statement loan. Instead of relying solely on traditional tax return income, certain bank statement programs may evaluate deposits shown in personal or business bank statements to help determine qualifying income. The lender may review a certain period of bank statements, analyze deposits, and apply the specific guidelines for that program to calculate usable income. And there can be different approaches here too. Some programs may use personal bank statements, others may allow business bank statements. With business statements, the lender may also have to account for business expenses when determining how much of those deposits can be considered income available to you personally. That's important because seeing $20,000 deposited into a business account doesn't automatically mean that's $20,000 of personal monthly income. The business still has expenses. You may also hear of these loans called non QM loans. Non QM loans are mortgage programs that don't fit within certain qualified mortgage standards, such as traditional mortgage programs like the conventional loan. That doesn't mean the loan has no underwriting standards. That doesn't mean anything goes. It means the lender has alternative ways of evaluating a borrower's ability to repay and documenting the loan. Bank statement loans are one example of that broader non QM world. Now, here's the part that sometimes get left out. Alternative document options gives the borrower more options, but that flexibility can come with a trade-off. Depending on the loan and the borrower, you may see things different, like different interest rates, down payment requirements, reserve requirements, credit requirements, or additional documentation. Every lender and program can have its own guidelines. So the goal isn't to say bank statement loans are better than traditional mortgage or traditional option. The goal is to figure out which financial structure actually fits your situation. So, who should probably explore this? Maybe you're a business owner, maybe you're an independent contractor, or a consultant, or freelancer. Maybe your business generates strong cash flow, but your taxable income doesn't reflect on what you believe you're actually earning. Or maybe you tried to qualify before and somebody simply just told you that your income wasn't high enough to qualify. Those are situations where it's worth taking another look at the complete picture. And don't wait until you've already found a house. If you're self employed and you're thinking about buying in the next 6 months, 12 months, or even further out, having this conversation early can be extremely helpful. We can look at how your income is currently documented, which obstacles currently exist, and which options are worth exploring. Sometimes traditional financing works perfectly fine. Sometimes an alternative program makes more sense. And sometimes the answer is simply that we need a little more time to prepare. So if you're self employed, don't assume that your tax return is the entire story about your ability to buy a home. Let's look at the full picture. Traditional financing, bank statement programs, and other non QM options may all be worthwhile reviewing depending on your situation. The goal isn't just finding a loan, it's finding the right way to document your financial picture and determining which makes sense the most for you.